The broadcast is now starting. All attendees are in listen-only mode.
Good afternoon for the majority of the country, morning for our folks over on the West Coast, and welcome to the Source HOV Tax webinar, where today we'll be delving deeper into the opportunities and implementation aspects of the recently passed CARES Act. I'm Chris Henderson, President of Source HOV Tax, and I'm joined by Charles Duncan and Brian Coddington, who will be guiding us through the material. So glad you joined us today and hope the information covered will not only be informative, but also useful to this current tax season, now prolonged tax season, and into 2020. We have a lot to cover in the hour allotted today. I know there will be many questions. We'll get to all of them. Please rest assured that we will certainly follow up with you afterwards. All of the questions will be accumulated, and we will push that out to all those that registered. In addition, for folks that answer at least 3 of the poll questions, you will be eligible to receive CPE. We will email your certificate to you within 14 business days. One more bit of administrative housekeeping: the slide deck will be available for download anytime during the presentation. And with that, let's go ahead and get started, and I'll turn it over to Charles Duncan. Charles?
Thank you, Chris. So for today's agenda, we're going to start off by talking about Q property, specifically the 15-year qualified property, and how that has changed from what we knew prior to the Tax Cut and Jobs Act, and how it's now been modified with the CARES Act. That morphs into a discussion about QIP in particular, qualified improvement property. From there, we'll talk about the bonus depreciation rules and how those have been impacted by the CARES Act. After that, Section 179 rules, which are fairly straightforward, but they're rather interesting. And the Tax Cut and Jobs Act certainly did a lot to improve the benefits from Section 179. Finally, we'll follow up with Section 163J and where that stands now. So with that, before we kick off the actual presentation, Chris, do you want to start us off with our first polling question?
Absolutely. Thank you, Charles. All right. Hopefully everybody can now see the polling question. And let's start off with a little bit of primer here. Question is, for the CARES Act, did what for retailers? And your choices are A, allowed them to exist lawfully; B, allowed a 15-year recovery period for interior building improvements; C, forced them to apply for government loans; or D, none of the above. Give everybody just a minute here. Time to answer. There will be 5 polling questions throughout the presentation. Again, 3 required for CPE credit. Okay. We are ready here. All righty. All right, Brian, why don't you jump in here and add any comments on this first question?
Well, as you can tell, a couple of the answers are somewhat facetious. Allowed them to exist lawfully. It certainly helps that they'll be able to get a 15-year recovery period and a possible bonus depreciation boost for their QIP investment since 2018. But B is the correct answer. C is the answer for all the tax practitioners out there that it probably feels like, because that's all everyone has been doing since the CARES Act came out. But the correct answer should be B. So if we can advance to the next slide.
Very good. All right.
All right, so let's get into a discussion about 15-year qualified property. Prior to the Tax Cut and Jobs Act, we were relying on qualified leasehold improvements, qualified restaurant property, and qualified retail improvement property to assign a 15-year life to any new interior improvements to an existing building. For qualified leasehold improvements and qualified retail property, there was a 3-year rule involved. For qualified restaurants, the rules were a little bit different. And since 2009, it had been more expansive, allowing for the Q property to apply to that entire building, whether it was an acquisition or new construction. These rules were very complicated, and they did change depending upon which year you're looking at. They gave us a lot of opportunities, but overall they were confusing for taxpayers. One of the things that the Tax and Jobs Act had intended to do was collapse these 3 categories into a 4th category of qualified improvement property. Qualified improvement property was introduced under the PATH Act. Its original purpose was simply to allow new interior improvements that were real property to qualify for bonus depreciation. As most of you know, at this point, that was broken. This is a big part of what the CARES Act fixed for us. When the TCJA was signed into law, apparently Congress had forgotten to do their cutting and pasting properly, and QIP came out of that with the loss of bonus depreciation. It no longer received it, and it did not get a 15-year life, which it was supposed to get under the Tax Cut and Jobs Act. So now, beginning January 1st of 2018, we no longer had any of these other types of Q property, qualified leasehold improvements, qualified restaurant, qualified retail. We did have QIP, but QIP was broken. Now, the CARES Act has retroactively fixed this. So retroactive to 1/1 of 18, qualified improvement property, QIP, is now 15-year property. QIP now expressly is limited to improvements made by the taxpayer. This last point is important only because there was some misunderstanding. I guess there was enough wiggle room in the wording of the QIP rules that some people were stretching the definition of what could qualify as QIP, but it's expressly limited to new interior improvements made by the taxpayer. And we'll go into a little bit more detail about QIP in the upcoming slides. Chris, if you could forward it, please. So this chart gives you a history of 15-year qualified property. Beginning, the chart begins in 2001 and it goes all the way into the post-2018 period, which we're in now. Over time, we've had the introduction of qualified restaurant property, qualified retail improvement property, qualified leasehold. And you can see from the chart that anywhere where there's an orange cell, that's where the rules apply only to new interior improvements. And there was a 3-year rule that applied. The green cells indicate where, for instance, qualified restaurant property applied to both new and purchased property, as well as the entire building. And this is true all the way up till the end of 2017. After 2017, these first 3, because they disappear, we no longer have to worry about a 3-year rule. Instead, we have QIP, which in its corrected state now applies only to new interior improvements, and there is no 3-year rule. And one of the interesting things that I've seen over the last year and a half is taxpayers trying to still follow some of the original qualified leasehold improvement rules and apply them to QIP. And so I would see taxpayers, worried about the 3-year rule, in trying to qualify for that QIP. And it's just absolutely not necessary. The QIP is specifically new interior improvements, and there's no time limit on it whatsoever. It's just new interior improvements made by the current taxpayer to an existing building. And then that's really important. It's super easy to qualify for QIP. Chris, if you could move on to the next slide, please.
Okay.
And one more, we'll go into the more of the specifics of what QIP really is. So when it was introduced under the PATH Act, The definition was those new interior improvements placed in service after the original commercial building. It does not apply to multifamily housing. So it doesn't apply to apartment complexes, nursing homes, dormitories, things of that nature. It does not apply to elevators or escalators, nor to the interior structural framework of a building. And when we're talking about the interior structural framework, what we're really talking about here is load-bearing walls, concrete slabs, steel beams, things of this nature. But if you got the inside of a typical commercial building, and all you have left is a column grid, and then you renovate that entire interior of that space. Everything that you've just put into that interior of this, the interior of that space is either going to be personal property, 1245 property with a 5 or 7 year life, or it's going to be QIP property, which now under the CARES Act is 15-year property that qualifies for bonus depreciation, with the exception of any elevators, escalators, or any work that's done structurally. Now, when we're doing cost segs, and usually if if an opportunity is crossing our desk, it's because someone has spent a significant amount of money. Typically, they've spent north of $500,000, or even more often north of $1 million before we start looking at it for cost seg purposes. In those cases, very often those TIs aren't limited to just the interior space. You see this, for instance, in a shopping center where most of the TIs are on the inside, so you have a large amount of QIP property there. But it's also not unusual to see work done on the exterior facade of the building, exterior windows, doors, signage, or in other ways, doing work on the exterior of the facade to help with the branding of whatever retailer is in the space. So a good rule of thumb to think about is if someone has a significant spend, is not assuming that everything's going to be automatically QIP in there, but going ahead and trying to verify that there is no exterior work whatsoever. And it's very easy to verify whether or not there's elevators, escalators, or if they did anything structural. So when QIP was originally introduced in 2016, it received 50% bonus depreciation. Now, under the TCJA, we had a retroactive clause in that, which allowed us to start receiving 100% bonus on some property that was placed in service after 9/27 of 17. It doesn't apply to everything. There's rules we'll talk about momentarily, but we do have this introduction of 100% bonus depreciation after 9/27 of 17, and we continue to have that to this day. The CARES Act has, of course, made this viable for QIP property. When the TCJA eliminated qualified leasehold, qualified retail, and qualified restaurant property, one of the things they had to do is pick up the responsibility of those three types of property that qualify for Section 179. So QIP after 12/31 of 17 now qualifies for Section 179 expensing. And again, we'll cover this later on in the presentation in more detail. And of course, if you look at the far right column of the slide, you can see that QIP did not have a short life before the Tax Cut and Jobs Act, but now, due to this fix from the CARES Act, we have this 15-year life. Chris, can you advance slides, please? So for the past 2.5 years, we've been, in our practice, we've been identifying 39-year QIP that did not receive bonus depreciation, but it might qualify for Section 179 if someone could otherwise qualify for that. So we've been breaking it out on our reports, and we were following a permissible method because during that time, that is what QIP was. It was 39-year property. However, under the CARES Act and this retroactive fix to what they call the retail glitch, the IRS now considers treating QIP as 39-year property an impermissible method of accounting that must be changed. This isn't terribly difficult to do, and we'll go into some detail, explaining how that's done. But for all those cost segregation studies, or if you didn't do a cost segregation study, but you at the time correctly identified QIP property as 39-year property, technically speaking, we are obligated to fix that. And the great thing is this obligation has upside. It's not, it's not penalizing us by making that change. So consider that treating cost segregation 5, 7, or 15-year assets as 39-year is also an impermissible method of accounting that must be changed. Anytime we're doing a cost seg study and you file a 3115 to change your accounting method, we're going from what is technically an impermissible method of treating the whole building as 39-year to a permissible method, which is treating the personal property as 5, 7, or 15. And now identifying the QIP, it falls in that same sort of category where technically it's impermissible under 39 years, and we're now moving into a permissible method. Due to the less favorable Section 1245 recapture rules, if building improvements that should be Section 1245 property are treated as QIP, the IRS may reclassify in the year of sale. And so why do we need cost segregation at all if you're doing these large TI projects? Well, as I mentioned on the prior slide, with the cost segregation study, we will pull out the things that don't qualify. In other words, we're validating the assumptions about what does and doesn't qualify. So identifying the elevators and escalators and those related costs and excluding those from from the QIP is important. A lot of renovation projects include enlargements. If you're expanding the volume of a space, that cannot be QIP. QIP only applies to new interior improvements, and this is something we see a lot with auto dealers, dealerships, where they may spend a couple $1 million on what may be called an image upgrade. A lot of that is new interior improvements to the existing space, but it's very, very common for auto dealerships also to expand the square footage, expand the volume of space. Now, if all we're talking about is adding internal mezzanines to increase floor space, that's not the same thing as increasing volume. However, if they're creating new internal mezzanines, then there will be a structural component there that would not qualify as QIP. And so these are the sorts of things that we would identify and treat properly. And finally, the internal structural framework is not QIP. So, for instance, interior earthquake-related improvements may not be QIP. Chris, if you could advance, please. And Brian, Brian, are you with us? I know you were having some audio problems a minute ago.
I am back.
Wonderful. Would you like to go ahead and take over and discuss the procedural guidance?
All right. So this slide is very dense, and I apologize for that. This division you see is between the pre and post RevProc 2020-25 timeline. So before the RevProc came out, before April 17th, 2020, if you were going to change your methods for QIP after the CARES Act came out, you had a couple of options. You could amend your 2018 return, but only if your 2019 return had not yet been filed. And if you were a BBA partnership, and I hope everyone at this point knows that BBA stands for Bipartisan Budget Act of 2015. It's the system for partnerships that replaced TEFRA. So those guys can only file an AAR, that's an administrative adjustment request, in the current year, which if they had already filed 2019, and we got to remember, The due dates weren't extended for 3/15 at the time, and still haven't been unless you filed an extension. If there had been no extension filed, they were going to have to wait till 2020 to be able to file that AAR. And if you didn't fall into that trap of being a BBA partnership, you could file a designated change number 7, Form 3115, under the normal automatic consent procedures of RevProc 2019-43. And that could be done with your 2020 return. It could be done with your 2019 return. And if you'd already filed your 2019 return, unless you're one of those BBA partnerships that didn't extend, you could even file it with a either an amended or superseding 2019 return under the automatic relief provisions of Regulation Section 301.9100-2. Now, for QIP placed in service in 2019, there were some options. You could amend it, but you still ran into the same trouble with BBA partnerships, depending on whether they had extended or not. And hopefully everyone is extending their BBA partnerships as a matter of course each year so that they can still have the opportunity to file superseding returns as necessary. Now, that was before the RevProc came out. After the RevProc came out, so on 4/17/2020 and later, we have a lot more options. First, the new DCN 244 is a lot shorter than 7. A lot of the toughest parts of filling out any 3115 have been eliminated. Even some of the questions on Schedule E on page 8 of the 3115, you can skip, such as a question about, is this residential rental property and have you lived in it? Yeah, that's not relevant to QIP because it's only for 39-year buildings, so we get to skip that. So if you're just changing from 39-year to 15-year and claiming bonus, or perhaps 20-year if it's ADS and you don't claim bonus, then you can use this short DCN 244 and with your 2019 or amended 2019 return. You can do that in 2020. The service has even said if you're not worried about some of the scope limitations and the eligibility rules, you could even wait till 2022 and later. Now, if a taxpayer amends a return under RevProc 2020-22 to withdraw a Section 163J7 election, all of the bonus changes happen under that RevProc. So anything you need to do will happen under the amended return there. Now, another neat thing about why you want to follow the new procedure, and in fact, if you're changing for QIP, right now you have to follow the new procedure. You can't go back to the old RevProc. You don't have to use the UNICAP cost capitalization rule for the cost subject to the change. So, for instance, let's say you are a company that had a lot of QIP and the depreciation for that QIP has to be capitalized under UNICAP, but you aren't doing that. If we use DCN7, well, you have to make a concurrent UNICAP change to fix that. With DCN 244, you don't have to do that. This is the most generous of the scope provision waivers that they issued in the new RevProc. It's very similar to what they did with the TPR 5 years ago. Another neat option is that even if you filed 2 years of returns using the impermissible 39-year method, so you filed 2018 and 2019 already, you can go back and amend the method of accounting using amended returns. That is a huge win for taxpayers. Historically, the service does not allow method changes on an amended return, and they very rarely allow method changes without a 3115. We get both of these for QIP. And the real reason for that is if you've already filed 2018 and 2019, they're trying to allow us to do what Congress allowed, which is push an NOL from QIP, the QIP fix in 2018, all the way back to 2013 with the new 5-year carryback. If they forced us to abide by the typical procedural rules for method changes where you can't do it on an amended return, that wouldn't be possible. So this is a great win for taxpayers. Now, obviously, if the taxpayer doesn't want to go through the expense due to the number of K-1s, the number of state returns, they can elect out of the NOL carryback. They don't have to go back and amend. They can file 3115 in 2019 or 2020 and get it handled then. One thing I should mention about the issue of do we have to fix it is when we're looking at the, normally they're not going to force you to go from 39 to 15 year and pick up bonus depreciation, but it's possible if there's an understatement of your section 199 cap A qualified business income deduction, they might do that. They might look at it. Or there could be issues if you're selling your QIP in the near future and the service wants you to pick up more as 1250 recapture in excess of straight line rather than unrecaptured 1250 gain. And finally, RepRoc 2020-25, it does do other stuff. I'll mention some of this later. It allows you to make late elections, allows you to revoke elections, and even withdraw otherwise irrevocable elections for ADS and for grafted plants, for electing out a bonus depreciation, and for electing 50% bonus depreciation in lieu of 100% bonus depreciation in that fourth quarter of 2017. So Chris, if you'd please advance to, I believe it's time for another polling question. So if you could tee that up.
Absolutely. Thank you, Brian. All right, I think the poll is open, and poll question number 2 is this: do we have to change QIP from 39 to 15 year? Choices are obviously A, yes, or B, no. Give everybody just a minute here.
And Chris, this is of course a very simple yes/no question, but it's one of the most important questions, the most important substantive issue of this presentation perhaps is, do we actually have to make this change? And I'd like to remind the viewers that it doesn't necessarily, just because it has one answer doesn't mean that you have to do something or not do something today. So if we're ready, perhaps we could see the results.
Wait just a minute here to get their response in.
Okay.
And those should be coming up.
And the important thing is that maybe I should have asked this question with today at the end, because in that case, the answer would clearly be no. But if we're talking about in general, yes, the service does expect you to make this change. But in terms of making the change, it's very much like cost segregation. Technically, you have to make that cost segregation change, or you should, if you are aware that they have purchased 1245 property or constructed 1245 property or other short life property along with their building property. But as we know, every day people don't do that. Sometimes it's immaterial, sometimes they just don't get around to it. So yes, people should do this. Yes, people should probably do this in the as soon as possible for the most advantageous year, but it's not something that has to be done today. So if we can move on to the next section, and I think Charles will take that over.
Sure, Brian. Thanks. So let's talk about bonus depreciation for a few minutes. This is an area of immense confusion and has to do with how the TCJA was originally written. And what I'm getting at is that when we talk about the changes to bonus depreciation, they were retroactive to after 9/27 of 17, whereas everything we just talked about as far as QIP, it was effective after 12/31 of 2017. And now because QIP interacts with bonus depreciation, you do get some interesting effects that I'll show you on the following charts on the next slide. But when we're talking specifically about bonus depreciation, remember that this change began after 9/27 and the QIP changes began after 12/31 of 17. So for bonus, property acquired and placed in service after 9/27 of 17 qualifies for 100% bonus. And I really should have inserted the word may qualify for 100% bonus. The PATH Act is still there, and there's a transition period that we'll discuss in a little bit based on the binding contract rules and work of significant nature. If someone's buying new property off the shelf after 9/27/17, it'll get 100% bonus. But if it's something that's being constructed over a long period of time, that's when we have to look at those binding contract rules. The bonus stays at 100% until 2023, where it drops to 80%, and then it drops an additional 20% every year until it's eliminated in 2027. But hey, seeing as how they haven't been able to get rid of bonus up to this point, no matter how many times they've tried to phase it out, I wouldn't be surprised if it came back again after 2027. The original use requirement was removed after 9/27 of 17. This is fantastic. So all those acquisitions of buildings that used to not be able to get bonus depreciation now can benefit from it. And this makes a large difference. So bonus now applies to purchased as well as used and as well as new items. It does not apply to property received as a gift or from a decedent. In general, for like-kind exchanges or involuntary conversions, the bonus applies only to the excess basis, the money put into the deal to trade up, for instance. If the replacement property is original use, both exchanged and excess basis may qualify for bonus. And then it doesn't apply to property acquired in a non-taxable exchange, such as a reorganization, property acquired from a member of the taxpayer's own family, another related entity is defined in Section 267, nor to property acquired from a person who is controlled by, or is under common control of the taxpayer. And finally, it does not apply to property used in certain utility trades and businesses. Chris, if you could forward the slides, please. So this slide gives you a history of bonus depreciation. So on the far left side, you see a bracket for the Tax Cut and Jobs Act and a bracket for the PATH Act. They do overlap in time. The TCJA did not replace the PATH Act. We have our date ranges following that. Then you have your pre-TCJA bonus. We were showing going all the way back to 2011. Obviously, we have a history of bonus going back to 2001, but it's unlikely that anyone on this call really cares to look back that far. The column after that is the TCJA bonus, which begins at 100%, just as the pre-TCJA bonus is phasing out. And then the next set of columns, the next 5 columns, deal with different types of property, the various types of Q property, as well as Section 1245 and land improvements. As you can see from that middle column, Section 1245 property and land improvements always receive bonus in years in which we have bonus. The orange cells indicate where bonus applies only to new property or original use property, and that's the period before the TCJA. The green cells, they indicate where bonus applies to new and purchased property. Of course, that's post-TCJA. QRP and QRIP, so these are qualified restaurant property and qualified retail, have never ever qualified for bonus depreciation on their own merits, but would only qualify for bonus if they were also coincidentally qualified leasehold improvements prior to 2016 or QIP property after 2015. And so that covers those last two columns for qualified leasehold and QIP. In the middle of the slide, you have the area that's circled in red, and this is kind of your sweet spot where because of overlapping provisions, bonus is really at its most powerful, where it applies both to new and acquired property, and it's at 100%. QIP is receiving bonus. So that's kind of our sweet spot until we get to our phase out after 2022. So Brian, is there anything else you want to add before we move on here?
Yeah, I would like to point out that pre-2011, I believe there were a couple of instances where restaurant property did qualify on its own. I seem to remember that that was a change that Congress actually had to introduce, but that's a long time ago for look-back studies. And of course, when looking at something of that age, we would put it through normal due diligence where we appropriately determine that. But one thing to point out is that QIP applying only to new property, we have that in the post-TCJA years. It's not because of original use, but rather because these have to be improvements made by the taxpayer. And if something's not an improvement, or if it's not made by the taxpayer, which would typically be used property when we're talking about QIP type 10 improvements, then that's sort of what forces it to just be new property. It's not the original use rule. It's these improvement and made by the taxpayer rules, which hopefully the service will issue further guidance on that, because there are a number of issues that can come up, which we won't get into today, that will affect whether something should be 15-year or 39-year. So if we can move on to the next slide.
Absolutely. Thanks, Brian. So I have to say, I think that most people, when they're trying to decide whether or not property gets 100% bonus, that they are almost solely looking at the placed in service date. But what we've had for bonus depreciation, going back to its original inception, were the binding contract rules. And this table here tries to explain when do we apply the PATH Act rules versus the TCJA in these transitional years. And this is primarily applying we're applying this to construction projects or projects that have, they're contracted a long time ago. It takes a great deal of time before delivery. So on the far left, you'll see where we're breaking down the examples into whether or not they fall under the PATH Act or the TCJA. That's really what we're trying to determine here. If it's under the TCJA, then we get kicked up to 100% bonus. If something's still under the PATH Act, then we have to look at, what years are placed in service and the phase out of that that particular type of bonus. The next column is whether it's an acquisition or original use. So, it's either one or the other for our purposes in this table. Then in the middle of the table, we have three variables: the binding contract date, work of a significant nature, and placed in service. For non-original use property, such as the acquisition of a restaurant or some other piece of real estate, we're going to be looking at that binding contract and the placed in service date, and we're going to ignore that middle variable. And this is easy. It's like a light switch. If the binding contract was before 9/28/17, then it's automatically going to be under the PATH Act, and that restaurant or that vehicle or whatever it is that's being purchased will not receive any bonus depreciation. If the binding contract is after 9/27 of 17, then obviously the placed in service date will also be after 9/27 of 17, and that's going to be under the TCJA. That's simply by looking at the binding contract. And under the TCJA, it will get 100% bonus. For constructed assets, I'm not going to go into too much detail, but there had been controversy over the last couple of years in terms of what's called self-constructed property. I'm going to leave that for another discussion. But for our purposes, realize that when we're talking about buildings, they take a very long time. You know, the contract to begin construction could have been 2 years ago, and construction, you know, then there may have been a development phase of several months before the shovel ever hit the dirt. And so you look at that binding contract, but because it's so removed in time from when a building is complete, we've had what is essentially a safe harbor that we've been using ever since '01, and that was looking at, instead of the binding contract, work of a significant nature. And what that's really asking us is, has 10% or more of the physical labor, the physical construction, begun prior to a particular date, in this case, prior to 9/28 of 17. If work of significant nature had occurred before that date, then you fall under the earlier tax provision, which in this case would be the PATH Act. Once you know you're under the PATH Act, then you go to the fourth column, placed in service, and based on placed in service date, that tells you what type of bonus it is. So if it's placed in service in 2017, it's 50% bonus. If it was placed in service in 18, it's 40%, 19, 30%. If it's placed in service in 2020, it would not receive any bonus if you fell under the PATH Act. Now, if the work of significant nature did not occur until after 9/27 of 17, then you're under the TCJA, and all the way up through 2022, you're going to be receiving 100% bonus depreciation. And the reason a lot of you probably, and I'm guessing because I've had a lot of conversations with people over the last couple of years, many people don't remember this, or they only remember when they're reminded of it. Oh yeah, I forgot about that. We had so many consecutive years of 50% bonus depreciation that we were all getting the answer right without knowing why we were getting it right under the pre-TCJA. And most of us had just simply forgotten, or we just didn't need to worry about this. But for some of these transition projects, for instance, if you have a construction project that's placed in service in early 2018, there's a high likelihood that construction project actually largely falls under the PATH Act, not the TCJA. And I say largely because we do have some ability to kind of componentize the construction project. And Brian, that's an area where I invite you to weigh in on where we stand as far as that goes. Again, these are rules that have been evolving over the last couple of years. We had some proposed bonus regulations that came out September of 2019 or thereabouts, or that we're specifically dealing with that. So Brian, why don't you update us on that specifically, componentization?
Well, here's the good news. The service is aware of these issues. And while the self-constructed rule in the final regs takes us a great deal of the way towards having a more sensible approach to self-constructed property, they're still looking, last time I checked, on having more fully developed componentization rules, perhaps. And in fact, they were looking at these when the CARES Act came out and the world shut down. Unfortunately, the CARES Act caused all TCJA-related guidance to be pushed aside, and for the wonderful guidance we received from the service and Treasury to be pushed out very quickly. So I anticipate that somewhere in the summer, maybe July, maybe towards the end of the 2019 filing season, maybe in September, we're going to start seeing more TCJA related guidance come out, the final bonus depreciation regs, and some of perhaps the 163J regs. But right now, we are waiting on the service and Treasury getting fully up and running and finishing with the CARES Act, which for depreciation purposes, I believe, has mostly been accomplished.
Thank you, Brian. So, Chris, I believe we have another polling question.
We are. All right, poll question number 3. And this one is, do all original use shorter life assets placed in service after September 27, 2017 qualify for 100% bonus depreciation? The choices are yes, TCJA bonus depreciation is based solely on when an asset is placed in service, or no, it also depends on when the asset was acquired. Give everybody just a minute here.
And this is a great question. If there's a single issue that you can take away from this section, aside from the great chart of the different dates, it is, what's the correct answer to this question? Because it's an area that is very frequently overlooked by many practitioners, and far more so by pretty much all taxpayers. In fact, if I were looking at the, a typical depreciation schedule, and Charles, you please feel free to weigh in, the actual written placed in service date is very frequently something that is open to question. Just the placed in service date. The acquisition date, which I'm sorry, but most software providers don't provide an okay. We have about an even split. And I think the character limits for the answers may have influenced this one, because the correct answer should have been no, it also depends on when the asset was acquired. But the character limits took out the also. So we got to remember, and this is the most important point about bonus depreciation, this section, for TCJA 100% bonus, we have to base the rate and the availability of bonus not just on when it was placed in service after 9/27/17, but whether it was acquired after 9/27 of 17. And that's based on either the binding contract rules for purchased property, or for self-constructed property, it's based on work of a significant nature, which is typically, we use a 10% safe harbor that the service has provided for many years. So answer should have been B. And if we can advance to the next section.
And Brian, I'm going to apologize because I've only left you about 12 minutes to cover 179 and 163J. I would suggest try to move quickly through 179 and spend the bulk of the remainder of your time on 163J.
Well, I do believe I will do that. So 179, key points I want to make are that post TCJA, it's indexed for inflation. We see here the indexed limits for 2018, 2019, and 2020. So even though we may refer to them as 1 million and 2.5 million, they are indexed for inflation, and they go up, generally speaking, every year. Want to make the key point that qualified real property is eligible for 179 expensing. That used to include qualified leaseholds and restaurants and retail improvement property. Now it's solely made up of QIP and some other stuff like roof improvements, HVAC improvements, exterior fire and alarm system improvements, and exterior security system improvements. And tangible personal property and qualifying software that is used for lodging, like at apartments, can now qualify for 179 expensing. So advancing on to the next slide, we see this wonderful chart that shows what I talked about just a second ago in graphic form. So no need to recap that. We can move on to the next one. And what did the CARES Act do to 179? Well, there were no direct changes. And if QIP was expensed under Section 179 on your 18 or 19 returns, you don't have to change anything. Now, do you want to? Maybe. If you are looking at planning opportunities, 1245 depreciation recapture applies to everything that's expensed under 179, but 100% bonus for QIP uses the 1250 recapture rules. So if you know that you're going to sell, your taxpayers are going to sell their QIP in the next couple of years, you'll probably want to look into amending their return to switch from 179 expensing to 100% bonus depreciation so that they can use the more favorable 1250 recapture rules. And also, now that we have the 5-year NOL carrybacks, which should generally go to higher rate tax years in the past, if you're looking at a substantial QIP loss, generated loss in 2018, and before it got caught up in 179 carryovers, a lot of people did that. A lot of people did that because the pre-CARES Act NOL carry forwards were less favorable than the 179 carry forwards. So now that we have the carrybacks for NOLs to higher rate years, you might want to amend to create a loss using QIP, where you couldn't create a loss using 100% bonus, where you couldn't create a loss using 179. So those are a couple of planning opportunities. And key point, if you expense something under 179 in 18 or 19, you can't use the 3115 to fix it. Because it was previously expensed, that's still outside the scope of the automatic change procedure. So you have to amend. That's one of the few cases where you're forced to amend, just like under 163J. So if we can advance on to the next slide.
And Brian, I think we've got a poll question. I want to get that in for everybody right quick.
So we have our, sorry, Chris, go ahead.
Our fourth question here, let me read that out for everybody, and Brian, I'll let you comment. If a taxpayer sells QIP for a gain, does it matter whether the QIP was deducted under Section 179 or using 100% bonus depreciation? Again, the answers are A, yes, or B, no. Brian, thoughts?
You know, this is another one. I hate to use yes, no questions, except where they really are a true substantive issue about, you know, a very important point. And then this one is, what type of recapture applies to each of the provisions? And hopefully, since we just went over this, we'll get plenty of right answers. And it looks like most everyone has answered yes. So since we're running short on time and 163J is a big section, we will move on. All right, so we're primarily focused on auto dealerships, but the CARES Act changed stuff for everyone. So as we know, 163J limited your interest deductions for most tax shelters and for non-small businesses to the sum of your interest income plus 30% of tax EBITDA plus your floor plan financing interest if you had any. And if you were what they call a qualifying real property trade or business, you could make an election to have unlimited interest deductions, but it came at a price, and the price was bonus depreciation on QIP and ADS on QIP and 27.5 year and 39 year. Because there was no bonus on QIP, tons of people made that election. So if we can advance to the next slide. Here we walk through typical situations with dealerships, which are typical representative of many types of taxpayers with PropCo and OpCo setups. Since we're running short of time, we're going to skip this section and we should advance to, let's see, a couple more slides. Next slide. The CARES Act changes, yes. So here's the big deal. The tax EBITDA limit for 2019 and 2020 has been bumped up from 30% to 50%. This doesn't apply to partnerships. For taxable years beginning in 2019, they get their own special rule. Now in 2019 or 2020, if for some reason you want to do this, you can elect to apply the lower 30% limit. That's done by doing it that way on the return. No formal election statement required. So if you've already filed a 2019 return, you might want to revisit it if they need to use a higher 50% limit. Now, partnerships, for 2019, they get to use their excess business interest expense for the partner level. They get to treat 50% of their allocable share for that as an interest deduction in the first taxable year beginning in 2020. So that's great. You can elect out of that if you want to for some reason. And the best thing outside of the bump up from 30 to 50% is that in 2020, you can use your 2019 tax EBITDA to figure your limit for the 163J limit. That means if your taxpayer has had a devastating 2020, they aren't going to get unfairly cut off from taking interest deductions. That's a great election. You do that by filling out your 2020 return that way, and you can revoke or withdraw or make late elections for all of these things using RevProc 2020-22. So now that we're coming up close to the hour, I believe there's a final polling question that we will want to bring up.
Okay. Let's go ahead and open that poll. And this last question, question number 5 is, which will affect more of your clients? And we've got 4 good choices here. The first one being the election to use the 2019 tax EBITDA for the 2020 163J limitation. Question or response B, the 50% excess business interest expense, EBIE election for partners. C, the ability to make or withdraw prior 163J elections. And D, the increased 50% of tax EBITDA limit.
For my part, Chris, I'm really curious to see what the answers are on this, because my gut feeling is that A and D are going to be selected by most people, but hindsight is rarely, the ability to use hindsight is a rare gift from the service. So maybe C is going to be an interesting 50% tax EBITDA limit is at 45%, so unsurprising, followed by the using the 19 EBITDA limit. And then in third place, we have C, using hindsight. And only 8% of respondents have voted for the 50% EBIE election. So just about what I was expecting. But that's great news, is that the service has allowed us, Congress and Treasury and the service have allowed us to do all these wonderful things. So now we're at the top of the hour, and I think we're going to stick around for questions.
Yeah, just a couple of questions here. Maybe going back to an earlier section, what does it mean that the improvement has to be made by the taxpayer?
That's the most important substantive change to the QIP rules in the CARES Act, and made by the taxpayer. this was in the regulations the Treasury put out that defined what QIP was. But there were some taxpayers who were taking the position that if there were existing tenant improvements and a property they acquired and they acquired a depreciable interest in those improvements were entitled to the 100% bonus depreciation, the 15-year life, and so on. So what's happening here is Congress is really shutting down that opportunity. It just makes clear that the taxpayer actually has to make the improvement. It can't be an improvement made by someone else, some prior owner. So you don't get 15-year life on acquisitions outside of land improvements, unfortunately.
And Brian, to me, this is just a clarification of something that was implicit in the PATH Act when QIP was originally created, but because it wasn't explicitly enumerated in the rules for, under the PATH Act, people felt there was some wiggle room to make these other arguments. So the CARES Act just shuts the door on that.
Exactly.
Very good. Another question here. This one also on QIP. Does QIP apply to all taxpayers, or are there any businesses or industries type of taxpayer where that's option or benefit is limited?
Well, the big limit is multifamily, like apartments, anything that's 27.5 year, nursing homes, care facilities, anything that we run into that uses an overall 27.5 year life for the building does not get QIP for improvements, which is actually, it's unfortunate, but on the flip side, if you're dealing with a lot of mixed use developments, it does create a planning opportunity to make sure that if you can avoid the application of the 80% test to classify it as 27.5 year, if you can get the overall building classified at 39 year, and you're going to have a lot of subsequent improvements, then you can force it to get 100% bonus on those 15-year QIP improvements. So that could be a great opportunity. But again, since a lot of real property owners value the 163J interest deductions over the QIP, it's not something that is an old rule that we can say you're always going to want to have mixed use classified as 39 year. You really have to look at the different components, the interest deduction component, the 27.5 versus 39 plus 15 and bonus component, and figure out what's going to be the most advantageous for that taxpayer situation.
Very good. And maybe our final, go ahead, Charles.
Oh, I was just going to, expand on something Brian said with the 80% rule. It's a reminder that when you're talking about these mixed-use properties, when Brian said 80%, what he's referring to is a ratio of the rental income, and to be characterized as multifamily housing or residential real estate having a 27.5 year, 80% or more of the gross rental income has to come from these residential units, residential rent. And so to the extent that rent prices can be manipulated or tenant mix can be manipulated, that does give a planning opportunity with those mixed use developments. Should someone desire to be 39-year property versus 27.5, or if they have a preference for having 27.5-year property. And that's really, you could have a whole half-hour conversation just on thinking about that strategically.
Yep. Very good. Maybe the final question, as I know we are tipping over at the top of the hour here. This one goes back to the QIP and 39 versus 15-year. The question here, along with a few others, is the 39-year QIP really an impermissible method according to the IRS? And does this mandate us taking some action?
Well, that's how the service has defined it. That's how they used RevProc 2020-25. And The thing about impermissible methods is that you have to have permission to change them. You generally have no obligation, of course, to go back and amend a return to fix it. And you can fix it prospectively on the first year that's open to fixing. For some, they'll be 2019. For some, they'll be 2020. But the service has, in their informal comments, said it's not a huge issue. And that's typically how tax accounting methods have been treated historically. Yes, something may technically be wrong, but if it's an immaterial difference, if the fixing it would be favorable to a taxpayer, generally the service, on exam at least, doesn't force people to change. Now, of course, due to QBI and the 199 Cap A deduction, where it could lead to an understatement by understating the depreciation, well, that might be a situation where you need to do the math and see if it makes an actual material difference. And if it does, you might want to fix it as soon as possible. Now, if you can't fix it for some reason, such as QIP hasn't been, you know it's there, but it hasn't been identified, perhaps you should disclose that on a Form 8275 and wait till the next tax year when you've had an opportunity to identify it fully to implement the fix.
Very good. At this point, this concludes our webinar for today. Again, I know we are just a few minutes over, so I appreciate everyone hanging in there with us. We thank you for participating and hope that this has provided valuable insight and takeaways into what I think is generally positive legislation at a very trying and dealing time. We know there are many issues out there, and we know that these items are just some of a few of larger issues that are taking place. The conversation will continue, so rest assured, again, if we did not get to your question, we will do so after this webinar. We at Source HOV Tax want to be your resource on these issues, and we'll be reaching out in the near term here in the coming days, not only to give you your CPE certificate, but also to see if we can help in any way, answer any questions, or talk about client-specific situations. We are here to help. So again, thank you for participating and joining us today. Stay safe, and we look forward to talking soon. Thank you all.